Welcome to the Global Economic Outlook 2026, an updated collective view from over 120 economists. We'll examine the impacts of a significant geopolitical event on the US dollar, oil price, stock market, bond outlook, and the risk of a world recession. The Iran war was an economic earthquake. The closure of the Strait of Hormuz instantly overturned all pre-war consensus forecasts. Brent oil spiked dramatically. The US dollar rebounded as a safe haven, and recession odds jumped, forcing the Fed to rethink its rate path. Oil prices shifted quickly from a glut to a crisis. With 20% of the global oil supply disrupted, hundreds of tankers anchored, and strategic reserves released, forecasts are now highly volatile, driven by the war's duration. Pre-war, most economists anticipated a moderate decline for the US dollar. Post-war, the DXY initially saw a safe haven rally to 99. The updated consensus predicts a near-term war premium, followed by a decline as de-dollarization accelerates. The US stock market showed initial resilience, with a buy-the-dip reaction. However, the key risk is oil. If the conflict lasts longer than a month, and oil prices sustain above $100, the risk of a broader sell-off rises sharply, especially for small caps. The war created an impossible dilemma for the Fed: cut rates to protect jobs, or hold/raise rates to contain the oil-driven inflation surge. Pre-war consensus favored rate cuts. Now the rate path is frozen, with markets pricing in only one cut later in the year. Recession odds jumped from unlikely but possible to a coin flip. The US is relatively moderate risk. However, Europe and Asia-Pacific face high risk due to energy dependency. The Middle East is at severe risk, being the epicenter of the conflict. Comparing the collective views, the West sees a V-shaped or moderate decline for the dollar, while China and the Middle East focus on structural de-dollarization. Recession risk is highest in Japan, Europe, and the Middle East, while the US market is viewed as more resilient. In conclusion, the tail risk of geopolitical conflict has materialized. The consensus is that oil prices will eventually return to the $65 to $75 range after the strait reopens, but this could take months. The dollar is not crashing, but medium-term weakness remains likely. This addendum includes 3 deep dives into critical areas: the dollar's reserve status, the forecast for copper and critical minerals, and the outlook for the Middle East over the next 5 to 10 years. The US dollar's share of global reserves has declined from 71% in 1999 to 56.9%. At this glacial pace, the share would drop below 50% by 2039. Despite this, the dollar still dominates global trade, FX trades, and international debt denomination. Economists in the West believe the dollar won't lose its status in their lifetime. China, however, is actively building parallel systems. The Iran war accelerates de-dollarization, as sanctions confirm the dollar can be weaponized against nations. Copper is often called the new oil due to its demand drivers like EVs and grid infrastructure. JP Morgan predicts a significant global refined copper deficit in 2026. Supply shortfalls are anticipated by 2035. Lithium is currently oversupplied but will face a deficit by 2030s. The immediate impact of the war on the Middle East includes instability in Iran and damaged infrastructure in Gulf states. Structurally, the energy transition will accelerate. Diversification is urgent, and water scarcity is set to become a major security issue by 2030. We outline 3 scenarios for the Middle East through 2035. The best case, with a 35% probability, sees the war end quickly and oil return to $65 to $75. The base case, at 45%, sees elevated oil prices and delayed Vision 2030 projects. The worst case, at 20%, results in a global recession and regional power vacuum.